Hello, traders and investors. Steve Gans here, and I wanted to share a concept with you, and that concept is called delta hedging. So, what exactly is that? Let's talk about 100 shares of stock. If I have 100 shares of a stock, any stock, I have 100 delta, and we can see that right here at this P&L diagram. What that means is that for every dollar the stock goes up in price, I gain $100 in value in my position. For every dollar that we go down in price, I lose $100 in the overall value of my position. Now, that's all fine and good. That's handy dandy if the market is going up consistently and making higher highs. My portfolio overall would be doing well as the stock positions continue to increase in value. However, at some points in time, we hit positions like we have right now in the market where we get a lot of volatility. We get some fairly significant drops at certain times. And one thing I could do is I could go in and I could sell out of a lot of my positions if I felt the market was overbought. However, particularly in the United States, and if you're not in an IRA, that creates some tax ramifications. Now, I'm not trying to give tax advice here, but if you're trading in the United States, you can have short-term or long-term capital gains when you sell out of positions. So I've got positions that I've personally held for many years. I don't want to sell out of those at this stage. I don't want to have that tax bill that would be generated by that. But I also don't want to maintain this same level of risk, essentially being 100 delta, on my positions. So a way that I can accomplish my goal of reducing my risk without selling my positions is to use options. One of the ways that many people use options is they do what's called a covered call. So I can come in here, I'm going to now include this in this diagram. When I include this, we can see that by adding this in here, let me just kind of line this up a little bit with that 561 where I sold the call. So that's right at this point right here. So when I sell that 561 call, I'm taking in a certain amount of premium for doing that. I'm getting paid something for that. In this case, I'm getting $10.25. Again, every options contract is times 100. So I'm taking in $1,000 to sell that covered call. Now, having that come in helps to offset my delta. You can see my delta now, rather than being 100, my delta is 53. That means that if our market sells off $1, the market being SPY in this case, I'm going to only lose $53 instead of $100, because that covered call, as the market goes down, that covered call is going to be making some money for me. So it offsets, in this case, basically $47 of what used to be 100 delta. Now, a couple of things to note. I'm giving something up here. What I'm giving up is I'm capping my upside here. If the market were to rip up, or SPY were to rip up beyond 561, I am not going to partake in that. I will be gaining in profitability on that at this stage, $53 per dollar move, up to 561. Above 561, I'm not going to get any more gain out of that. So that's something I have to know that I'm trading off. And of course, I can choose to put this call anywhere I want. Maybe I want to put it up here at 570. I'm going to get a little less for that, and I'm going to get a little less of a delta hedge when I do that. But again, I can make those decisions and look at a chart, look at the market, and see at what stage I'm comfortable giving up potential upside. Now, I could even take this a step further here. Right now, I have reduced my deltas from 100 down to 53, but maybe I think we're in for a really rough patch here, and I want to hedge even further. I could come in and I could sell a second call if I wanted. Okay, and I end up in a position something like this. Now, when I do that, again, remember, I was picking up $1,000 per call I sold. So now I've picked up $2,000 in premium by selling those calls. I have flattened my delta considerably. Now, if SPY drops by $1, my account or my value of my 100 shares is only going to drop by $6, not $100. So I have significantly flattened those deltas at this point. And if I have a fear of a market continuing down, that's a good thing. That's what I want to do, because if the market does in fact continue going down here, these short calls are going to gain in value, or more of that money, that premium that I took in is premium that I will get to keep so long as SPY stays below 561 as we get to expiration. Now, again, the trade-off here, not only did I cap my upside in this case, I also gave myself some potential losses if the market rips up. In other words, because I've sold 2 calls, that represents 200 shares of SPY. I only own 100 shares of SPY. So that means that I'm on the hook for another 100 shares that I would have to come up with if that were to get called away from me. So I've got to be careful about particularly adding that second one. Adding one is not a really big deal, or adding one per 100 shares of stock is a pretty common way that people will generate additional income off of a long-term investment portfolio. Adding this second one to where you've totally flattened your deltas and you've added some potential upside risk if your underlying moves up significantly, that's something that's best left to options traders that have more experience and understand exactly what that all means. But again, the key takeaway here is there are ways to use options to hedge against downside moves. This is one of those ways that I wanted to share with you today. Other ways are buying puts, doing what's called collars. There's lots of other ways that things like this can be done, but this is one that I use all the time, and it helps me generate additional income in my accounts when I feel the market is oversold, or when I feel the market might have bounced to a point where it may end up retreating from that point. So I hope you found this useful. Thanks so much, everyone. And if you find this of value, please subscribe and give me any comments below. Take care.